Grow an actively managed portfolio of gold, silver, platinum, palladium, and rhodium with Auctus Metals today.
I expect in the next 6 months, and this is month 1 in the countdown. Close in November we started, so December's month 1. But in the next couple quarters after that November close, I think you'll see silver, with sharp sell-offs in the process, reach at least 200 and possibly a lot higher in a rampage.
Hello again, everyone, and welcome to another edition of the Auctus Edge, where we look to give that edge that precious metals investors are looking for. I'm your host, Patrick Vieira. Michael Oliver, founder of Momentum Structural Analysis, joins us today to talk about the momentum that we are seeing going on with precious metals. Michael, welcome to the Auctus Edge. How are you doing?
I'm doing fine, Patrick. Doing fine.
Glad to have you back on. I'm going to start off with the obvious. These wild swings, the volatility that we are seeing with metals, especially silver and even platinum. Why are we seeing these wild swings going on?
Oh, it's just part of the process. First off, best to measure the swings not in arithmetic points or dollars, but measured in percent scale. So, we just had a drop here today, literally in a couple hours from, like $10 or so, about 15% in silver. You can go back at lesser price levels over the last couple of years and see also 10, 15% drops, fewer dollars involved, et cetera. And so as we proceed higher, and I don't think this is just a shin kick interruption, you'll see plenty of them, you're going to get volatility like this. Where suddenly 1 hour you see it here and 10% lower or higher the next hour. As we rise. And I think silver is in an ascent to a new reality, not just a nice move, but, to some new reality price level. And we've made this point from various angles of analysis over recent months to our subscribers. But what do we mean by new reality? And we can get into that.
We'll definitely get into that for sure. But, looking back, through all these interviews that I've had the pleasure to do and people such as yourself, I had the pleasure to speak with, it seems like almost years ago, we were talking about bifurcation, where we have a paper price and then we have a physical price. So I wanted to ask you, is this what we are starting to see today? And is something like bifurcation between a paper and a physical price, is it sustainable?
It's probably an expression of the tightness of what's going on, but it's just a reflection of the underlying silver crisis that we're facing in terms of supply demand and its essential nature. I think even Elon Musk the other day said something to that effect, that we got to have silver for AI and so forth, and it's essential in all these tech things and so forth. Used to be, silver, primarily industrial use, was in photographs. Snap a picture, the processing involved the silver in the film. Now it's solar panels, powered the solar panels, the AI, massive technology buildup and so forth, where silver is just everywhere in there. And maybe in microscopic levels, but nevertheless pervasive and essential. And yet we've had 5 years, I understand, of we don't focus on supply demand. I'm looking mainly at the technicals, although I am fully aware of larger fundamentals beyond just silver's industrial thing. But we've got 5 years of supply deficit to demand. And it's not getting better, despite the rising price. In most markets, if a commodity is too low to incentivize more of the commodity, you take the price up. Therefore, you produce more of it, more wheat, more sugar, whatever. The case of silver, it's hard to do because most silver doesn't come from silver mines. It comes from base metal mining. And the primary incentive for those folks is the base metal price, not silver price, even though they get a marginal amount of silver, which is the majority of the supply comes that way. So it's kind of a unique fundamental and technical squeeze that's underway here. And that's why we claim it's going into a new reality. Don't think in terms of normality here. This is not going to be some normal bull trend.
That's an interesting point because, being that it's a lot of the secondary mines that bring silver to supply. let's say silver price does rise to a good number. Let's just throw $100 out there. Does that then mean that this higher number is going to bring more silver into the market, or would that really not matter?
No, that level probably wouldn't. We think silver's going to hundreds, okay? And I can't pin it down, except to say that I know if you fundamentally go back and factor in the decay in the U.S. dollar buying power, in other words, the quantity of dollars that exist, which goes up like, 80, 90% every 10 years, the supply of dollars. I'm not talking dollar versus euro or yen or anything, but literally the buying power of the fiat unit. And if you factored in getting to a price that reflects 1980, for example, when it was 50, or 2011 when it was 50, you'd be in a couple $100 just to get back to that level in terms of real buying power. When a market makes mistakes, either overpricing or underpricing, and everybody's especially aware of overpricing because we've seen stock market bubbles. And whenever that occurs, too high for too long, when it snaps, it doesn't do it rationally. It quite often overshoots where it ought to be. So it goes too deep, or just like on the upside, it goes too high for too long and then snaps the other way. Silver's been caught in a box for 50 years. You can look at copper or lead, and we've run studies on this, where they were caught in a range for multiple decades, 1970s, 80s, 90s, 2000, and in mid to late 2005, for example, copper had been in this old reality of price range. And it broke out, and literally in a couple of quarters, it quadrupled. And it wasn't in sync with other base metals. It was on its own, okay? Quadrupled in price literally in several quarters, going to a new reality, in other words. And then when it finally leveled off for the subsequent decades, past 20 years or so, it leveled off at a range that was like 4 times the average price of that prior range. But the process of getting from the old range to the new range was a thunderbolt. It wasn't, let's get up there slowly and methodological, in an incremental manner. It was literally ripped the page off. And it no doubt overdid itself in getting to the new reality and then pulled back into a new reality. Same occurred with lead in 2007. Very exciting metal, okay? Silver's been caught in this 50-year range. Gold hasn't been caught in a 50-year range. It has 8-fold moves. It goes way above the prior 1980 high or the 2011 high, et cetera, et cetera. Silver been capped. What's going on there? Is it a dog? Is it really non-essential? Lead did it. Copper did it, and I could find a dozen other markets that have done something similar over the past 50 years or so. But silver was contained. Well, it's no longer contained, and therefore it's going to do something excessive on the upside, getting to a new level of price reality. And it's going to be fast. And we're in that process, and we're just in that process. Only in the past month have we entered that phase. So put your seatbelt on. And be ready for days like what we're seeing today. When you were interviewing me, silver had a drop from $82 down to 71, and everything's, it's the end of the world. No, it's, another 10% so drop in a heartbeat. And it doesn't interrupt the real process underneath that's going on.
This has been a pretty volatile year for metals, where gold has been pretty steady and stable, but platinum, silver has been pretty volatile to the upside. And if you think it may be time for you to rebalance your precious metals portfolio and get in on these gains, please do visit us at www.auctusmetals.com. I'll get to that the drop in a bit, but Michael, last time we spoke back in July, I think silver was in the 30s or so, somewhere around there, and we talked, and the numbers came out: $60 an ounce, $70 an ounce, somewhere around year's end. And you nailed it. You got to that point, and now we are talking about this new reality. But I wanted to ask you, what led you to make that call back then in July, which you got right, and speak on this new reality that you're seeing.
We measure silver, we measure any market. We look at all kinds of asset categories, stock markets, bond markets, commodities in general, foreign exchange, especially the monetary metals, silver, gold, and miners. Okay. What was going on back then was you're already in a bull market. I mean, silver was already advancing. When we put out a major buy signal in March of 2024, silver was about 25, 26 bucks. We said, okay, it's coming out of its sleep pattern. It's been in since 2020. And whoosh, you shot up to 35. And then you effectively spent a year in a range with two peaks at 35, October of 2024 and March of 25, in a like a $10 range. And then when you came back up toward the top of that range in, like you said, in June, July of this year, we said, that's it, you're coming out of here. This time is the acceleration phase. No longer, let's gain $5 and halt and $5, et cetera. And so we whooshed up into the over 50. Okay. Fought there a little bit. And then next thing you know, we traded 82. Okay. All right. That was a technical signal we got from the momentum of the price action. In other words, just looking at price and its momentum. And we measure momentum differently than most people do. Anyway. And that told us, okay, this time silver is going to accelerate more than you've expected to see. This time, what happened that caused us to say new reality commencing is the spread relationship between silver and gold. The mama metal, gold, and the lesser child of the monetary metal, silver. And as we just talked about, gold keeps making higher highs over the decades and silver's caught in a box. Well, the spread relationship, when we plot an ounce of silver to an ounce of gold and express it as a percent, we plot that, okay, and we analyze that technically. The close of November, we had a spread breakout, meaning while silver's been underperforming gold since that 2020 surge in silver, remember when the post-COVID thing, silver exploded, doubled, and gold went up 40%. Silver outperformed them, but in the years that followed it eroded back down in relative performance, meaning it was going up with gold, but at a lesser pace. But that ended at the November close. And November, we closed in the mid-50s. Okay, here we are a month later with a couple days left, and we're in the 70s. Wow. $20 in a month? That's pretty cool. Well, what warned of that wasn't that silver's in an uptrend. It's been an uptrend for a couple years. No big deal. It's the spread breakout when silver broke out relative to gold. The same thing happened back in 1979 during that rush in silver. It went from like the teens to $50 in 5 or 6 months. Okay. It's when the spread broke out, silver favoring over gold, that suddenly silver went rampant. And it both went up, but silver just left the page. Okay. Same thing happened in 2010 during that already aged bull market in silver, been going up for years. There was a point at which its spread broke out versus gold, and in the next 7 months, silver doubled in a half. Boom, doubled in a half. Very quickly. We argued when the spread broke out this time in November that process is now commencing here for silver. And if you go back and look at that copper I talked about, or the lead charts even, when you entered that new search for a new reality, you did it so quickly. It was always a couple quarters. It's very amazing. And the same with 79 to 80. It was a couple quarters, like 5, 6 months. In the case of 10 to 11, it was 7 months from the spread breakout to the peak of silver at 50. I expect in the next 6 months, and this is month 1 in the countdown. We're already closing November. We started, so December's month 1. But in the next couple quarters after that November close, I think you'll see silver with sharp sell-offs in the process reach at least 200 and possibly a lot higher in a rampage. Yeah, there'll be a correction in the middle somewhere, probably. There was in 1979. There was a little correction in the middle that fooled people. Same in 2010 to 11. There was a reversal month. There was a fake out, and you exploded more. So sometime, let's say mid to late first quarter, you might get a correction that you could really call a correction. Not what we're seeing today. This is just a quick jerk, okay? But sit back and give it a couple quarters, and I think you'll see that it doesn't just get to what you could call a fair value based on the degradation in the money in it, meaning $200 an ounce or so, but probably overshoot it vastly. And plus, there's the other factor that we haven't talked about, and it's not just that silver's an key industrial metal; it's a monetary metal. And when certain other events outside of the monetary metals occur, like we have an underlying earthquake-type crisis building in some major government bonds, our bonds, Japanese bonds, UK, et cetera. There's a lot of big bond markets where there's underlying crisis already there, just hasn't ripped open and exposed itself fully. And when that does, that'll create huge waves of doubt and panic and impacts on other markets like the stock market, down, et cetera. So all these factors can come into play, in which case the central banks go ape, absolutely crazy, trying to save their government bond markets, and therefore printing money, which is the lifeblood of what gold is. Gold is money. You destroy your paper, gold goes up, etc. So I think that's the real underlying major factor in play here, not just the silver supply demand.
We're saying silver may be, let's just use the word recalled, back into some type of a monetary role, because I think already Russia has mentioned it. I think even India is allowing the collateralization of
Yep.
silver to have some type of monetary role. So we may see it being recalled alongside gold.
Yeah, I think so. And you'll see it here and then there. What's going to cause it to be more widespread, the monetization of monetary metals again, the recognition that, gosh, this past very long human lifetime, we have just printed 100 years or so. We've had a central bank here for 110 years that prints and prints in cycles. And it's true in Japan, it's true in Europe, et cetera. So, and it hasn't worked. And you've got to create, though, probably panic. And you'll never see panic on the face of a Fed governor. Okay, they're always, everything's under control. But I'm talking about the average guy. Because if you impact that stock market in this process, and I think the stock market has been topping since January, it's a laborious, marginally new highs, et cetera. It's the same thing it did in 2000, same thing it did in 2007, where you make a high, pull back, and make another new high, and everybody thinks, oh, it's going to go forever. But when that beast rolls over, and I think that's probably you're going to start to see evidence of that the average guy can realize late in the first quarter, and especially into the second quarter of next year, where, because it's the only thing people could smile about. Their retirement account. Hey, S&P's up 10, 15%. Oh boy. Meanwhile, gold's up, 100% or whatever, but they ignore that. But if you take that away from them, the average guy who's not really feeling that good about other aspects, financial aspects of his life, then suddenly there's doubt, there's fear. And you inject emotion into it, and that's when you get political ramifications and therefore pressures, even among academicians, to say, hey, this central bank thing hasn't really been working well. It's just been a matter of constant boom-bust cycles, monetary booms, stock market booms thereafter, et cetera, et cetera. And that's when you get the doubt and hence those kind of changes you mentioned. Right now it's just here and there, but it could be far more widespread when these other events unfold. And I think gold and silver know that's underway. The smart money buying it knows something's wrong out there. I want to own real money. And that's what's really the underlying power of these moves.
Yeah, I agree. I'm seeing a lot of that when people ask to buy some gold or silver. It's for the monetary value. It's for that a bit of a hedge, I guess you could say, against currencies. Uh, Michael, today, yes, we saw this big drop with silver price. Some people might say it's a healthy thing, but there was the talk of margin calls where COMEX had a margin call, and I'm just wondering, what could you tell us about COMEX margin calls and the silver price going down? Because some people, they equated this with what we saw back in 2011, where four consecutive margin calls brought down the silver price.
it's a factor out there, and it's indicative of what's going on in terms of one side being pressured or another, and these things off to the side that we like to cite, like, did this bank intervene to suppress silver, or they got caught and they're getting hurt, or whatever. These things are going on the side all the time, and you'll probably hear more of them, but they're not really the driving force. They are things that are going on in the process of silver going to a new reality. Gold's already, like I've said before, gold, each bull market well exceeds the prior high. Silver didn't, okay? Silver's changing that now. But gold's bull moves, for example, have been eightfold moves. Bear low to bull high, 1976 to 1980, eightfold, 8 times the bear low. 2001 low to 2011 high, much different span of time, but an eightfold move. Okay, if we have an eightfold move, in other words, if we just do it again, have another routine eightfold move, will be $8,500 because our bear low was 1,050. Okay, in 2015. So that's just getting back to normal in terms of having matched a prior bull market in terms of dimensionality. There's even bigger stuff going on this time than it was in 1980 or 2011. So we don't, I think 8,000 is just sort of, I throw the number out, not as a prediction, just saying, if it goes there, it's done it again, But we've got underlying stuff that we've not had before. In 2007, we had a mortgage crisis, meaning, mom and pop mortgages failed. Okay, not government bonds. All of a sudden now we got government bonds in trouble. And the Fed can cut rates all they want on the short end. It doesn't help the T-bonds. And the governor of the president of the New York Fed, I forget his name, Williams, I'm not sure, about a month ago made a statement. This is a press conference or a speech, but I'm sure it was permitted to be said, that the Fed is going to start buying, quote, buying bonds to help liquidity, was his excuse. Oh, not that there's a problem there. It's just the liquidity issue. Right, that's great. And he smiled. That's a statement that they're going to print money to save, the U.S. government debt market if they can. And if you look at the T-bonds, they're not an alternative to the stock market anymore. The 60-40 principle of 60% stock. It just doesn't work. In fact, one of the major banks came out with a statement a couple of months ago, said, no, it should be 60-20-20, gold being, it more likely should be 60% gold, 20-20. But anyway, the point is there's a recognition that something's wrong with that alternative. And if you look at a T-bond chart, it's like it's comatose. You can even have a bad week or so in the stock market, and it just sits there. It's not an alternative. And if it flinches about 4 points below where it is right now, we're trading around 115 on the T-bond futures right now. You get down around 111, watch out, put your helmet on, because you could have a downside collapse that sparks the Federal Reserve into something drastic and sudden, hence fueling the monetary metals.
Yeah, it's a great point you brought up about the liquidity and the Fed and these things, because when I took a look at the repo market today, Fed injected some 25 billion. When I look at the repo market Friday, was another 17 billion. So what are your thoughts on this, where the Fed is getting back in it?
It's there's a point at which if that doesn't work, and it doesn't work, all it's done in terms of the long end of the debt market is stabilize it. It hasn't rallied at all. It's just been dead since October of 2022, when it collapsed from 190 down to 117. Well, where are we trading right now? 3 years later, trying to base, have his rally, can't get going. Tries to base, has a rally. We've had 3 rallies since then, each of which have just fluttered and dropped back down. And we're 115 right now. It can't get off the mat. If you slip another 4 points, get back down to 111 and lower, we argued technically that there's going to be a downside plunge. Oh, yeah, the Fed will come in with fire hoses. But what does that mean? Print, print, print. Artificially lower rates, and especially money flow. They'll create it. And it's like lifeblood to the gold market. So that's the background fundamental that is the most major fundamental, not whether there's been margin calls on COMEX. COMEX has become, I was trained in the mid 70s. I joined EF Hutton as a broker. Gold had been legalized in January. I joined them in April. I stayed there for a year and a half in New York at the EF Hutton commodity headquarters. And the head of the department there was also chairman of the COMEX, a guy named David Johnston. Later, after I'd left Hutton and gone to another firm, still a futures broker, in 1980, they cut off all new buying in silver. They literally shut the market down. They said, no new longs, you'd only sell. Well, of course, silver then had gone from like $3 to 50. So, maybe it was ready to go down anyway. But I mean, they took that kind of step, not just raise margins. They raised margins on silver on Friday, I think, but it was like a 10% raise. Just they'd had a lot of incremental, nothing drastic. But that's not the determinant of the market. That's a thing on the side. That's not silver. That's just one avenue of accessing or trading the metal. It's not the core of the market. In fact, we now have silver trading in Shanghai that's probably more than the COMEX, and bullion trading not on an exchange. So the importance of the COMEX, it's noise. People like to talk about it because it's something they can understand, but it's really the bigger issues are what we've been talking about.
You think the COMEX will ultimately lose pricing to the Shanghai Futures Exchange, which deals in physical, and COMEX is...
Could be. I
Yeah.
don't know. I don't have a real strong opinion on that, except to say, why not? Especially to the extent that if we manipulate it over here more than they do, in terms of regulate it and think what's best for the market instead of letting the market do what it wants to, they could diminish in participation. But again, silver's bigger than that. It's not just the futures exchange. Back in the 70s and 80s, it was pretty important, COMEX was, but not anymore, nor even the Shanghai market. Silver's, again, it's an essential metal for the future and the present, in solar power, which is being in great demand, especially in underdeveloped countries that don't have a local power company, okay? You might have a cell phone, but you need some kind of solar panel in your backyard so you can power your house, etc. And therefore, the Chinese are selling that, around the world to a good audience, a large audience of people who need it. And that's a huge percent consumption of silver annually. Plus, then we have the high-tech stuff. It's everywhere in there. It's embedded. You can't shrug it off or replace it with something else. And that's the industrial side. But again, there's the monetary side. And people forget that, silver's the poor man's gold, and it's actually been money. And it could easily become money again. And even if it isn't actually recognized as official money, the average guy, when he gets hurt, especially if the stock market rolls over, and he suddenly doesn't have anything that looks good, and yet his neighbor down the street told him a couple of months ago, I'm buying silver bullion, and his neighbor suddenly doubled his money. And you say to yourself, "Oh, gee, I wish I'd done that." Maybe, and suddenly the average guy wants to own the poor man's gold again, and there's a rush there in demand. Those are the kind of factors they're all underlying based on these broader fundamentals than these little technical events off to the side, which is great for conversations, but it's really not the driving force.
Yeah, it's another great point because I think, as you say, great for conversation. There are so much conversations going on right now. Everybody, we're looking at one little piece, and then we're trying to put all these pieces
Yeah.
together, and we may be losing the big picture, which what you're talking about. So it's almost 2026. By the time this comes out, it may very well be 2026. What is your outlook in 2026 for the metals, for the economy, maybe even the US dollar?
Dollar's in a bear trend. We got bearish at 104.21 price dollar index, which really is nothing but an upside down version of the euro and the yen, which constitutes 70% of what is the dollar index. And it's now trading 97, 98 and just floundering around here for about 6 months now. Not every time it tries to rally, it just doesn't get anywhere. It just plops back down. We think it's already in a bear trend, and likely the bear trend will continue on down and challenge the prior major lows of a decade plus ago at 70 on the dollar index. But again, that's just comparing one piece of paper versus another. It's not reality. It's unreality versus unreality, okay? But that's a factor. And I think it's in play, but it's not noisy yet. It'll get more noisy if you drop another handful of points in the dollar index. Suddenly you're going to start to get people talking about it. The T-bond market, I think, is critical to watch. It's boring as heck right now, but that says something in itself. It's dead. What's wrong with it? It can't be manipulated or controlled very well by the central bank. And it's bigger than the U.S. stock market. The stock market, again, we think it's the U.S. stock market in particular has been topping since January. S&P then was just short of 6,200. Right now we're 6,900. So, it's gained some more since then after the sharp drop into April, which unfortunately was headline based. You don't want headline sell-offs. Headlines come later. You want the sell-off to come and people don't understand why. Okay. But anyway, we think it's in a topping process. We've made comparisons with what happened in 2000 and 2007 in terms of the laborious nature of the topping process, which spanned a year in each case. When that breaks down, that's going to cause real-world pain. Not just to retirement accounts, but that's when suddenly the data points don't just get a little bit negative, they get real dark, and they follow the market down. That's historically what usually happens when you look at those sort of data points, unemployment and all this stuff. It's really once the stock market starts down, that's when those things go dark. And that's when the central bank goes ape. And every time the central bank goes ape and starts printing and printing, it doesn't stop the stock market bubble break. You could go back and look at rate cuts from 2001 to 2. All the way down, they cut rates, and the market collapsed. 2007, September, they cut rates, surprise event. Market made a new high 4 weeks later, 3 or 4 weeks later, and that was the top. All the way down, they cut rates, didn't help. It helped gold, okay? This time it's even worse because our bubble is bigger in the stock market. S&P is like, 10 times it's where it was in the 2009 bear load, and it spanned 16 years. You go back and look at the 1929 top, it was like a 5-6 year bull market, and it was like a triple or so. .com, triple or so in price for the S&P to reach the 2000 peak. But it only was like 5 or 6 year bull market. Same with 2007. You made a low in 2002, you peaked in 2000. So a 5-year bull market. It was only a double or so. So we've got one that is monstrous in terms of bubble attributes. So when it breaks, the consequences will be far wider than just the stock market. So that's my analysis of that. The area that I think is a good place to start thinking hard about in terms of if you want to invest, don't want to use leverage, you already got some gold, so you feel like you're okay there, gold or silver, it's commodities in general. Now, most people think, well, if the economy goes down, commodities got to. No, they don't. Okay? The correlation is not good whatsoever. Look at the late 70s, commodities boomed when we went into a global stagflation, they called it. And then there's been other times. Commodities are very cheap relative to their own price history. Look at a Bloomberg commodity index. It's trading right now at about 110. Okay? It made a bear low in the upper 50s back in 2020. But the bull market peak in 2008 was 237 on the Bloomberg. And it dropped down to 50-something? That's like going to zero, okay? What are commodities, total waste of line? We don't need them anymore? Okay. And then you had that first wake-up rally in the early 2022. And when the war started, they peaked, okay? People think war helps commodities. No, it didn't. They peaked then. And they pull back halfway, either side of 100 on the Bloomberg, and it's laid there for a couple of years now. October's close indicated to us breakout. October's close was 107 on the Bloomberg. So now, again, we've reached up to 113 cents. Right now, we're at 110.11, 110 to 111. But that looks like a market that's ready to start its next major up leg in this new, what we think is an emerging uptrend, opposite to the stock market. And so I suggest to people that they give a lot of attention to energy-related stocks, XLE, ETFs related to oil, grain-related, agricultural-related sector stocks, base metal miners, not just gold, silver, but base metal stuff. And that's a place to consider being as an alternative to the U.S. stock market. And those sectors don't usually move with the stock market. You can overlay a chart of XLE, for example, ETF, with the S&P, and there's no correlation at all. So it's not like if the stock market goes down, XLE goes down. So you can count on the energy stocks and these other ones to be going up in a down stock market context. And I think it's simply a statement that, one, they're relatively cheap to the stock market, very cheap, historically cheap relative to the S&P. And commodities that underlie these companies are very cheap still, and are just saying, we've had enough. You print the money, it's going somewhere. Used to go into the stock market, now it's going into this very much discounted asset category. So I think it's another place to people to look at. And we'll be covering that in more detail as the events unfold. And we usually cover it monthly, the commodity category. But I think that's a major area for investors or investment managers to start thinking about, if I'm going to shift, where do I shift to?
Okay, it's another great point. Last question here, because I get it quite a bit from people. When silver had its all-time highs back in 1980, and then again in 2011, it didn't last very long. It was short-lived. And they have a concern where, could it be short-lived like it was back in that decade, or is just those decades, or is it just really a new time now, a different
I
time?
think we're going to a new reality, and silver is now engaged in doing what copper, lead, gold has done repeatedly, and it's about to go into a new price reality. And likely, if that new price reality is some zone of price over the next decade, of course, it could be monetized as well. We know that at $200 to $300 an ounce, it might overshoot that new reality in the process of getting there. Markets are not always rational. Silver certainly hasn't been for 50 years. To stay suppressed in a range where no asset in the world has been suppressed in the same range for that long. Copper has it, lead has it, gold has it. Why has it? And when it decides to correct that error, quite often markets have a tantrum that goes beyond the correction, a reasonable correction level, and exceed it. They get excessive, both ways, in this case, upside. So it wouldn't shock me in the process of going to a new reality of several $100s an ounce, let's say, or more, that it overshoots whatever that zone might be. And much of that should occur probably literally in the next handful of months. Within 6 months, give or take, of our spread shift, silver versus gold. Let me make another point. If silver has just broken out of a range since the mid-70s on price, but only marginally, it took out 50, it went to 80, and it's not even a double yet. Get to 100, at least you could say it doubled, okay? The spread relation between silver and gold, when we measure it our way, which is divide silver into gold, expressed as a percent. In 1980, it was 6.5% of the price of gold. 1 ounce of silver divided into gold. In 2011, when it surged in that other silver bull market, the spread got up to over 3% of the price of an ounce of gold. Right now, we're just above 1.5%. Okay, so why should, if silver's going to go into a new reality in terms of its price, and more or less catch up to gold, for example, what it's been doing, why shouldn't the spread also maybe do that? Now think about that. I mean, just to get to the 3% is a doubling in the current relative value of silver to gold. Doubling. So whatever gold does, silver could do twice as much just to get to the 2011 levels. And if you go to the 1980 levels and to take that high out as well, why not? Price taking out the range high. Why shouldn't the relative performance take out its prior highs? That's over six. Oh, good grief. I mean, divide an ounce of gold by the silver, and you won't believe where it might lead you. So I think that's something to consider. Now, we're not saying it's got to do that. But what we are arguing is in the 2 quarters after that spread breakout, expect something you didn't expect. Don't expect normal. Okay.
All right. Michael Oliver from Momentum Structural Analysis. Before we wrap up, can you let the good people out there know how they can follow you and get more of your insights?
It's Oliver MSA, Momentum Structural Analysis, olivermsa.com. And take your time. Go through our site, look at our unorthodox methodology. We explain pretty well how it functions, and ask for some sample reports.
Well, Michael, I want to thank you for getting in here right before the end of the new year, and I want to wish you a happy and prosperous new year, and I hope we can do this again soon.
Thank you, Patrick.
That was Michael Oliver giving you the edge on the economy and the momentum on precious metals. If you want more info on precious metals and insights, or you would like to know more about optimizing your portfolio, please do visit us at www.auctusmetals.com, and please do subscribe to our YouTube channel and give this video a thumbs up.